everybody, and welcome to this Q4 2023 investor update. I'm Jeppe Kirk Bonde, the most copied popular investor on eToro. If you want to use this presentation for anything, please go ahead and read the disclaimer here at the bottom. So the agenda for this presentation is that I'll talk about my background, then about my investment strategy, what I have in the portfolio, and then finally I'll go through the many questions that I've received in advance. So the reason that more than 20,000 people are copying me on eToro, among other factors, is that since 2013 I've had an average annual return on investments of 24%, which is really better than anyone you could fairly compare with, and also with a very good return to volatility ratio. If you wanted a higher return than that, you would effectively have had to take on a lot more risk. My background is that, growing up, I thought I was going to be a politician. My dad, he worked in the European Parliament as a member of the European Parliament and head of a group for 29 years. And so I grew up learning a lot about economics and politics. But then I decided along the way that the action was in finance and decided to do my university degree focusing in on finance. I then started work as a management consultant, advising some of the largest companies in the world with a focus on valuation, so calculating how much companies are really worth. Now, in very large companies, that's important if you want to know, whether to buy or sell a part of the business, acquire another business, or to figure out what you're yourself worth, or to understand how much are we worth if we do this versus how much are we worth if we do that. And then as I was working as a consultant, I was making more money than I was spending, and so I wanted to invest my money. And then I looked at what my pension fund and my bank had to offer, and I was quite unimpressed. My pension fund was only investing in Danish assets, so I thought, okay, that's not very well diversified at all. And my bank had very high fees, so I thought, okay, I can definitely do better than that myself. And then I compared all the different platforms, so how good are the fees, how good is the app, how good is the website, which instruments are available, how much do I believe in the platform long term. I scored all the different options on these factors, and then eToro came out as number one, and then I started investing on eToro. And then as my investments were doing very well, more and more people started copying me, and then in 2018 I decided to focus full time on managing my investments, and then quit management consulting. And since then it's continued to go very well, and then shortly thereafter I was number one on the platform. Now, I don't do everything on my own. I have some good assistants that help me with some of the grunt work and good stuff. I have a good network of experts that I trust on complex topics. If I invest in something, I must either myself be an expert or know someone who is. I also get very good support from eToro. Whenever I have any questions or concerns, they're always really fast to help me out. I subscribe to the best data providers and the best IT tools, so that what can be automated is automated. And finally, I like to highlight my three favorite experts, which are my three brothers. One of them, he is a CEO of a marketing company. One of them is an economist in the Danish Ministry of Finance. And the last one, he did his degree in computer science, partly in California, and now is focused on the effective altruism movement. So if any questions or concerns within these domains, then they are my go-to experts. My investment strategy is based on some principles that have been there all along and continue to be here. I focus on macroeconomics, so what kind of growth rates do I think different pockets of the global capital markets can have. I focus on megatrends, so these are trends that can grow by more than 10% for more than 10 years. Then I focus on fundamentals. That means really getting a full understanding of companies. What is it like to, what would I advise them to if I was advising their management as a consultant? I need to understand what it's like to be a customer there, what it's like to be an employee there, what the financial statements are like, what they might be like in the future, what the strategic options are, what the competitors might do, and all of these things. And that's all put together for me to value the company, to assess what do I really think this company is worth. Not what do I think other people think it's worth, but what do I genuinely think this company is worth. And I then compare that with the price. And then I want to invest in companies that I think are worth a lot more than their price. Then I focus on the long term. That's the most difficult one for people to really appreciate, because of course, if you're always right in the short term, then the long term should take care of itself. But in practice, when you're managing a portfolio or a business or your life, if you focus on the things that will matter 10 years from now or beyond and ignore everything else, then it just clears up removes a lot of noise and enable you to make much better decisions. And I think that is really a thing that characterizes all the greatest investors. That you can be a good investor by focusing on the short term, but you will not be a great investor. And there's a great quote by Benjamin Graham, the author of the famous book, The Intelligent Investor, and he was also sort of Warren Buffett's mentor. He wrote that in the short term, the market is a voting machine, in the long term, a weighing machine. And that effectively means that in the short term, it can be very important what other people think, but in the long term, if a company becomes very big and profitable, then it's very nice to own a large part of such a company. And I have the patience to wait around for the big things to really drive the long-term impact. Then I focus on risk management. That includes diversifying across different geographies, industries, and business models. Typically have around 60 investments in the portfolio, with none of them making up more than 6%. Currently, the biggest one makes up around 5%. And then I hedge against tail risks. So these are risks that are unlikely to happen, but if they do happen, they could have an outsized impact. So for each of those, I like to have at least a couple of stocks that could do very well if a scenario, certain scenarios were to materialize. Finally, I focus on keeping fees low. I don't do any leverage. I don't trade high fee instruments. I keep a quite low frequency. And when I keep my fees low, copiers' fees stay low. So that's keeping the fees low is just one more way you can squeeze more profits out of your portfolio. Then there are some areas where I see very good opportunities. I like companies that can deliver organic growth. That means that they can sell more products, or they can increase the price of their products. But it does not include companies that are just growing via acquisitions. So sometimes you can read at the beginning of an annual report that we grew revenue by 2% this year, and then I think, yes, that's correct, but actually that's just because you acquired another company. The core business shrank by 4%, so what you've achieved is really not that impressive. Other times you have companies that are managing to acquire other companies for a good price, and after the acquisition then use it to grow, and then that can count as organic growth, and that can be good as well. I like companies that are resilient, that can do well across many different scenarios, just not a few good ones. That includes companies that have very strong balance sheets, that have solid, sustainable competitive advantages or have a clear route to build them, and companies that can do well if certain tail risks were to materialize. Then I like companies that are profitable, real profitable, not just with accounting gimmicks or in ways that is not sustainable. I like especially if companies are able to reinvest that profit into themselves to grow the business over time. I like to invest in companies when they have a good new strategy, because that can sometimes mean you get to pay the price of the old strategy, but you receive the value of the new strategy. It's not enough for me that a company say they have a new strategy. I must see some real actions that prove to me they are serious about it. So changing the name of the company, selling a part of it, or making massive investment into something, that's something that tells me, okay, things are really happening here, not just a new strategy on paper. Then to understand which companies are good to invest in, it's quite important to understand something about the products and services that these companies are delivering. If a classic example of failing of that was when Steve Ballmer, the former CEO of Microsoft, he held the first iPhone in his hand, and he said, oh, it's too expensive, it doesn't have a keyboard, business customers won't want to use it, I'm very comfortable with our position. And he was of course proven completely wrong by the massive success of the iPhone. But that was an example of holding the blockbuster product in your hand and simply not being able to see that this is the blockbuster product. And in recent years, many people have made the same mistake with Tesla and will probably continue to make that mistake. If you are a smart shopper, if you are able to go out and find out what are the important features of a product, what is the smart one to buy, and you are able to buy the correct product and not constantly buy the wrong product, then that's one piece of the puzzle you've managed to fit in. And if you cannot fit that one in, then it just makes the whole concept of valuing a company very, very difficult. And finally, I like companies that are mission driven, not just because I sometimes believe in the mission, but because it can be a great way to attract and retain and motivate great employees without necessarily overpaying them. There are some companies where even if they are overpaying employees, they still can't hold on to the smartest, most hardworking ones. And there are others that are just absolute magnets for talent. Whether a company is in one end or the other of that spectrum might not show itself in the financial statements 1 quarter hence, but a few years down the line it certainly will. Then my portfolio on eToro is more than 90% invested in stocks, And I also have a property that I rent out, and many people that copy me, they own a property they live in and are building a stock portfolio. And this makes very good sense because historically stocks and property have been the two best investment categories. And if you look at rental income in terms of properties and for stocks, the properties these companies are delivering, and look at potentially delivering in the next years combined with the growth, they look like they're still the best things you can hold right now. Bonds have historically been okay. Now they're looking a little bit worse. Commodities have historically done next to nothing, but could potentially do a little bit more. Currencies have historically been terrible. They're currently terrible, and I think they will continue to be terrible. So whenever I have a lot of excess cash, I like to, as fast as possible, get it transitioned left in this chart and ideally invest it into some stocks. Then there are some big factors that really drive long-term economic growth in the world. I like to split it into the physical realm, the social realm, and the technology realm. So in the physical realm, it's very important how many trees we have in different places, how much oil is in the ground, how much of the different metals is where. I also focus on life, animals, but especially humans. How many people are we? How are the demographics changing over time? The companies that have the right products and services for the right demographics in the right place, of course, have an advantage. Then the realm in which the most value can be created or destroyed the fastest is in the social realm. So if you have a piece of paper or some numbers on a screen that prove that you own a property or a bond or some stocks or a piece of paper that's a US dollar bill, then these only have value because we all believe they have value. If we stop believing they have value, then that value they can stop being helpful instruments very quickly. And having those instruments can really help the world cooperate, trade with one another, and that unlocks a lot of value creation. And so that's why it's sort of trust in these systems can really help us create a lot of value, but it can also, if that trust dissipates, help make it disappear very fast. Now, why does anything have value? It's very easy for people to sort of intuitively understand why a house has value. It's made of bricks and mortar, you can really feel it, it's tangible. Obviously the house has value, but if everybody just wanted to be outside all the time and nobody wanted to live in houses, nobody wanted to look at houses, then houses would not have any value. And so sometimes what we as humans value changes over time. And if what we value is changing at a fast pace, then even if it's coming from a small part of society, it can suddenly be everywhere. And there can be some companies that really manage to lose or win greatly from such a change. Then finally there is the realm of technology, all the way from the deepest pits of the R&D labs to individual consumers making tweaks to how they're using the product in their own homes. And chief of these are the big foundational technological shifts, so going from the agricultural revolution to the industrial revolution to the internal combustion engine to the electronic era to the digital era, and now we are living through the foundational shift to the era of artificial intelligence. And then from those grand economic factors that can really drive long-term growth, we can see where the world economy is today. So growth is lower than it has been historically on average, and in the EU it's sort of ground to nothing, and it's while of course it's not good that the global economy is standing a bit still, it's not great, but it's not it's not completely terrible either. Now unemployment is actually quite okay. In most places unemployment is lower than it was before COVID, so that's actually really a sort of a positive in otherwise mostly negative stories. Interest rates have come up and are now significantly higher than they've been in recent years, but they're still lower than they've been by historical average. And although Jerome Powell 10 days ago said that there was potential for meaningful further tightening, yesterday they decided to maintain the interest rate. And inflation is still higher than is the official goal. If you look at how markets are trading inflation over the next 5 and 10 years, it's also still expected to overall be higher than what is the goal, and that is what's sort of driving the potential need for a little bit more tightening maybe, and there could potentially be this decent scenario where we tighten a little bit more, which is sufficient to bring inflation back to target without really pushing us into a severe recession, and if it's a recession, maybe just a quite a manageable one. Then there are some mega trends that I've identified as extra interesting. So if a company is driving or riding on the wave of one or more of these megatrends, then it's more likely to be found in my portfolio. So firstly, I'll focus on the nice to haves. So when we humans, we have it all, then we like to compete with each other in fun games and who can have the better fashion, and hopefully one day we can have a world where we can focus much more on such nice things and not have to worry too much about all the other things. And there are some great companies capable of delivering high profits and extraordinary growth within these segments. But the nice to haves can only stand on the shoulders of the need to haves. If a country doesn't have security, then all of these nice to haves may easily fall away, and the companies that are key to providing that security are to be found in the portfolio. Secondly, if you don't have your health, then it doesn't matter whether your goal is to help your family or to do well for yourself or help the world. You can't do any of these things if you don't have your health. And extraordinary things are happening within health, and some companies that are delivering on that are to be found in the portfolio. And finally, there are the enablers and accelerators, so the things that can help us do these other things faster, better, cheaper. Chief of these is artificial intelligence, so the companies that are and have been making the biggest breakthroughs within AI are to be found in the portfolio, along with the companies that are going to be providing us the most amazing new devices in the future. I have been following OpenAI since its very founding back in 2015. Many people, they had their big AI moment when Kasparov, he was defeated by Deep Blue in chess. My big personal AI moment was in 2017 when OpenAI's Dota AI defeated Dendi. I saw that, and I saw it was playing with a level of creativity that was really extraordinary. And then with that in mind, as soon as I saw that Microsoft had initiated the collaboration with OpenAI, I massively increased my stake in Microsoft, and that turned out to be a very good decision. And now I think that the winners within the space of AI are not just in the companies that are delivering it, but it's also in the companies that can potentially make great savings from using AI. And then there are some other companies that can sort of get some benefits in a roundabout way. Now, once you've identified a group of companies that are worth looking at in some way, could be an industry or some ecosystem or another group of companies that have some reason for why you'd look at them at the same time, then a great way to get a quick overview is to look at the multiples. So this is an example of 5 big American tech companies, Microsoft, Apple, Meta, Alphabet, and Amazon. So if we look at the top left corner, we can see that all of them have very good profit margins, except for Amazon. They are lagging quite far behind in this metric. Now, in terms of growth, they're all doing quite well, except Apple. They've been declining a bit. Now, Apple is releasing their new numbers tonight, so we'll see if how things have changed since last quarter. Then these 2 top charts, the higher the better, because they're fundamentally about profitability and growth. The 2 bottom charts, the lower the better, because they're effectively about price. So at the bottom left corner, we can see that for every dollar of profit that Microsoft is bringing in, we have to pay $26 as investors. So that's a little bit high, but not too bad. For Meta, we're only paying $17. But for Amazon, we're paying $56. So now we'd only want to pay that much more for Amazon if we believe they can either increase their profit margin or potentially sustain or even improve this growth rate. Otherwise, we wouldn't want to pay that much more for Amazon. And if we look at the bottom right corner, we can see we are paying $11 for every dollar of Microsoft, for every dollar of revenue they have. But they're also getting a lot of profit out of every dollar of revenue. For Amazon, on the other hand, we're only paying $3 for every dollar of revenue, but they're also not getting that much profit out of their revenue. So that's sort of a quick way to look at the multiples. Now, in one day, I can look at many thousands of numbers, and I typically look at them in big data tables. Some of those come in automatically from my data providers. Others are populated by myself and my assistants. It can be subjective, but still numerical. So for instance, I could evaluate how much do I like their website on a scale from 1 to 10. That would be entirely subjective. But by placing a number on it, I'm not just saying like, well, this one is nice and this one is good, great, nice and good. I make it numerical, say, okay, put it on a scale from something to something, then I can use that in my models, and then those models help me make valuations and analyze how my portfolio and other assets could perform in different risk scenarios. Then, when I value companies, and I rank companies for how good investments they are. Sometimes there might be new companies that I find that I need to learn more about. Then I make a decision to do more research about it. And as I research companies, I tend to learn things that then help me change my models, but then makes me look at the world in a different way, which might make me look at something else I need to learn more about. Then I learn more about it, and thus it sort of spins around in a circle. When I originally invested in Facebook, I made a very big analysis of Facebook, looking at all the things they could potentially do in the future, how they could perform in all the different countries and so forth. But in learning about Facebook, I didn't just learn about Facebook and and I didn't just become able to make a good investment in Facebook. I also learned about social media advertising in general, and I thought to myself, I wonder what kind of companies are advertising on Facebook. Are these the smart companies? Are they the dumb companies? Oh, maybe these are the smart companies. Maybe my valuation model should include something about social media advertising. And effectively, then by having that, it helped me change the way that I look at other companies. And every company I analyze always has something that's unique about them, something that makes them special. And if you learn what that is, and then then that helps you think differently when you're looking at other companies, and it's sort of, you just add that up over time, and eventually you get a good way of looking at things. And as I do valuations and then make research decisions and so forth, those eventually lead me to my investment decisions. So I might have a company I've invested in and I want to invest more. Maybe I want to get rid of some of the stocks or sell it off entirely. Maybe invest in something that I don't have in the portfolio. And when you add up all those investment decisions, then of course you get to my portfolio. Now, if we compare that with the US economy, we can see that in the US it's not just one industry that has all the economic activity. There is economic activity across many different industries and great investment opportunities across many different industries. In my portfolio, I'm slightly more invested in tech, in climate and renewable energy, in financial services, in metal and mining, and in health and biotech. The largest holdings in my portfolio right now are UBS, Microsoft, and Meta. You can always go into the eToro app on the eToro website and see exactly what I have in the portfolio and what percentages. So that was my initial presentation here. Now I will go through all the questions that I've received in advance. So firstly, Ørsted just tumbled over 20%. Do you think it represents a good buying opportunity? Now, many years ago, I was invested in Ørsted and I did quite well with that investment. Then I sold most of it off and then the final stake, and it's basically been declining since then, so that proved to be very good timing. Now, I think it's a great company, but I think they are facing some real severe challenges, and I think the now cancellation of 2 major projects in the US is really symptomatic of that. And I think even at this price reduction, it's still not interesting enough for me to have in the portfolio, but it's a stock I cover and potentially it could one day find its way back into the portfolio. What are your thoughts on Bitcoin and Solana? So firstly, for Bitcoin, I love the idea of a private currency with a fixed supply, where in total there will never be mined more than 21 million Bitcoins. So I don't have to worry about someone suddenly creating a lot of extra Bitcoins that suddenly, there will be massive hollowing out of the rarity of Bitcoins, because the total supply will be limited in that way. That's really nice. Now, unfortunately, you can't really do quick, fast, cheap payments with Bitcoin at scale using existing technology, but that technology will get developed to run side by side with Bitcoin and enable this. And when it does, then it'll be, maybe not as good a currency as the US dollar or the British pound, but potentially much better than many currencies in the world, and maybe even better than these currencies as well. And I think that's certainly a future that's worth holding for. Then Solana, I think it's quite impressive what they've done with the proof of history, and I think that certainly makes it interesting. It's not one that I've chosen to have in the portfolio, but it's certainly one that I look at because of the, I think a great technological innovation. What is the dividend yield of your portfolio? So it's 1.65%. Many companies in the portfolio pay out dividends. Most of them do it on a quarterly basis. Some of them do it on a half yearly basis. And then when they pay out the dividends, it stays in the copy. Then when I reinvest those dividends, copies automatically do the same. And then it just continues automatically like that. When you look at the return statistics, then it also automatically includes the dividend component, so you don't have to do any extra calculations to get to the correct number. And if you go into your account statements, then you can always see all of the things that have ever happened to your portfolio, so exactly which companies have, for instance, paid out dividends to us. What is your short-term market prediction? So as I highlighted earlier, I focus on the long term. If something won't matter 10 years from now, then I'm really not that interested in it. So for instance, many people might think that it's very important what's going to happen with Apple's sales of iPhone this quarter. And while that is, it's not important. It's not completely unimportant, but if you look at the total value of Apple, the sales next quarter is not that much of it. It's only really relevant insofar as it helps you predict what will happen much further down the line. What is much more important to me, for instance, with Apple right now is understanding what might happen with Apple Vision Pro. Maybe 10 years from now, Apple will be selling 0 iPhones, but they'll be selling 300 million Apple Vision Pros. Now, any little detail that can help me decide whether it's going to be, oh, they won't sell any of these and they'll die and nobody's going to buy the iPhone, or this, or it'll be a world where everybody needs this new headset and it's going to make a shit ton of money for Apple, pardon my language. That is what I focus on in the short term, and then I care much less about these other little things. And I think a lot of people, they can be good investors by focusing on the short term, but they will not be great investors. I have thought long and hard about what kind of investor I should be. You know, I could, for instance, be an investor who would be paying a lot of fees every day or every month to slightly adjust all my positions to try to take advantage of something I think is going to happen in the short term. And if I evaluate what I would make on that, I think it would be good, but not great. And so that's not what I choose to do. I think the greatest alpha in the markets, where there is the least amount of analysis done compared to how much should be done, is still in the long term. And that's why I focus on that. If everybody was focused on the long term and way too many people had great ideas about what was going to happen in the long term, yeah, then maybe I would have to do something else. But that's not the case right now. Way too few people are able to focus on the long term. And so those of us that do, we happen to be all the ones that are the best investors. Considering a recession in 2024 is a possibility, do you have a strategy to minimize the downside? So minimizing the downside, that's really the exactly what all the risk management is about. So every day I ask myself, not just, is there a way I can potentially increase my average return? I also ask myself, is there a way I could sort of, almost keep my same potential average return across scenarios with slightly less risk? So I always look at both. Sometimes it's in one camp you can find the opportunity, sometimes it's in the other. And by diversifying across different geographies, industries, and having specific assets that can do well when others do bad, I minimize my downside. It doesn't mean eliminating the downside. If I wanted a portfolio that would be in positive every single month, I would have to construct a very different portfolio. For instance, investing only in inflation-protected government bonds. Then I would be almost guaranteed to be in positive every month, but I would also have a much lower average annual return in the long term I evaluate. And so that's why I don't do that. I'm happy to have some bad periods and some good periods if I evaluate that those periods added up make for a much higher total return. Then I'm happy to take on that volatility, accept that level of fluctuation. I can be comfortable with that, knowing that that is really where my money in the long term should help me make the most. And effectively you can see that, if every month you're given the opportunity to take something that is risky but on average good. If you do that month after month, year after year after year, then the good and bad times, they average out, and what you're left with is really that potentially higher average annual return. Is it possible to maintain a high return given the current economic situation? So the current economic situation compared to a historical average is a little bit worse, but not by much. So it's a decent time, and most of the time investors should be invested in the stock market. And you have to invest in something effectively, or do something with your money. If you just keep your money in cash, then that's also doing something. And when I evaluate the different asset classes, I think stocks is currently the best one. I think even if there's a recession, there are many companies that can still be a little bit profitable, at least through a recession. And on average, a recession lasts just 2 years, causes stock prices to fall by up to 20%, causes unemployment to spike by a couple of percent, and that's really not that bad. So if there's a risk that might happen, and if it happens, it could be something like that, then on the flip side, if you look at how extraordinarily positive returns stocks on average yield and how often they do it, then overall, I'm happier to have more stocks now than I would be to, for instance, just sit on commodities or a low interest yielding account that could potentially not even outpace inflation by much. Do you intend to close any of the profitable positions to buy other companies? So when I close positions, there might be ones that are in profit, there might be ones that are at a loss. That really has no impact. It's a common misconception, this idea that, oh, the stock has gone up. If it's gone up, that must mean that now it's too expensive. Oh, this stock has gone down, so now it must be cheaper. In reality, it doesn't matter if a stock has gone up or down, and it doesn't matter whether you are in profit or in negative. Apple is either a good investment today or it's not. Apple doesn't care whether you have been investing in Apple for 1 year or 5 years or 10 years. Either it's good today or it's not, and that's the real question. Is it good to have right now? Not whether it would have been good to have in the past 2 years. And a stock is not necessarily better or worse because it's gone up or down in price. It's a little bit the same as, if I tell you to go down to the supermarket and buy me a Coca-Cola, I need you to buy 1 liter for $1. Then you come down to the shop and they say, oh, sorry, we don't have Coca-Cola for $1 for 1 liter anymore. Now all we have are 2-liter bottles for $2. They'll say, oh, so the price is twice as high, yeah, but you're also getting twice as much. So the question isn't if a stock has, if a company has done extraordinarily well, they've invented new products, they have a better CEO, they're offering better services, it's simply a greater company, and the price has also gone up. If the company is now, in my evaluation, worth 3 times more, but the stock price has only doubled, then I consider it an even better investment opportunity. I consider that the stock is relatively cheaper now, even though the price has gone up. And the same when the reverse happens and the stock declines in price. It might be declining in price, but if it's actually lost much more value, then it's an even worse deal. So you can't just compare what the price is today with what it used to be to determine if something is a good investment or if it's relatively cheap. Why do I have shares in Meituan? So this is because there was some pressure from the Chinese government towards their tech sector, and as part of an attempt to alleviate that, Tencent decided to spin off Meituan. So for every 10 Tencent shares anybody had, you received 1 Meituan share as a special dividend. And so all of my copiers had Tencent shares because I had Tencent shares, and so we all received this separately as a special dividend, and then that's how it was spun out. And so that's why if you find yourself owning some Meituan shares, it's a dividend you receive from Tencent. What happened with the Bakkavor trade? So this is a $2 billion market cap approximately UK foods company, and if I buy shares in a large company like Apple or something like this, there is always sufficient liquidity to make a trade. But with smaller companies, there can sometimes not be enough shares available for sale for me to buy. And for most small investors, that's never really a problem. But if you buy all the shares that are available for sale, then there are no more available. Then you just can't buy anymore because they're not available for sale. And sometimes when I click to make a trade on eToro, it says trade rejected because there was not enough shares for sale so that me and all my copiers could simultaneously make an investment. And in this case with Bakkavor, that's what happened, except that for some reason it wasn't rejected. So I managed to make a trade, but nobody got to copy the trade. Then after speaking with eToro, I decided to cancel the trade, and then it was closed. So that's what happened with the Bakkavor trade in short. What is your take on the Financial Times article about eToro and you? So I always wanted to be in the Financial Times, and it finally happened, so I was very happy with that. And I think it showed a quite favorable portrayal of me, although it was a bit it also highlighted a lot of risk copy trading, some of which I agree with, and some of them I think are small misses, but overall very nice. I unfortunately didn't manage to pick up a physical copy, but I've written to them, so hopefully I'll be able to receive one, so I have it as a little, I don't know what to call it, like a memorabilia thingy. What do you think of Michael A. Guyot's research papers on leading indicators? So I didn't know who this was before I received this question. Then after receiving the question, I read one of his research papers and watched or listened to 3 of his podcasts. And I would say it's the kind of analysis that I don't really find useful for investment purposes. It is not by any means bad, but it's based on a philosophy that you can sort of use price changes in one area to predict what will happen with price changes in another area. And I fundamentally don't think that there's any alpha able to be generated from that way of analyzing things. I think that's just applying standard thinking to publicly available data, and I don't think that there's any alpha in doing that. So while it can sound interesting, I don't think it's really something that I can use to make excess returns. When copying, do I have to close positions myself, or is it automatic? So it's automatic. So when I close a trade, copiers automatically close the trade. When I then reinvest the freed up cash in another position, copiers automatically do the same. Now you can actually manually close positions. So I remember back in the day when I was investing in Monsanto, there were many copiers who didn't like Monsanto and wanted to manually close that trade, and then they did that. So that's possible as well, but otherwise it's automatic. How much should I copy with? So that's a very effectively, I can't provide advice or recommendations, and to be able to do that, you need to understand the individual financial situation, what's the individual's risk profile, and so forth. Now, for someone who is earning minimum wage as a student in Europe, the most important piece of capital that you got to allocate is your time. So that might mean, investing in getting a good education, might mean investing your time to do well at work, to get promoted so you can earn more than minimum wage and so forth. Now, if you have cash and you're about to spend that cash in a stupid way, it could potentially be good to invest it in stocks, both for the return from the stock, but also potentially from the value of learning that can come with owning stocks. If anybody has a high interest debt, for instance credit card debt, then it's most sensible to pay that off first before investing in stocks. Anybody who knows they'll have to sell the shares to use the cash for an expense within the next few years should also most likely not invest in stocks, but instead invest in potentially an account that yields interest for that specific piece of time. To invest in stocks, you should at least have a time horizon of 5 years, ideally at least 7 years or more, ideally forever actually. And the maximum you can invest on eToro in one copy trader is $2 million. The minimum is $600. And if you invest more than $50,000, then that makes you in the Platinum Plus category, which has some benefits, although that might be a very high amount for someone who's earning minimum wage and is a student. So I think it can be very nice to just start with a demo account with $0 invested to learn, what's it like to click the buy button, how does this platform work, what is stocks all about, and then potentially just make a small account with some real money, so that you keep in the back of your mind that instead of ever spending money on something stupid and making a bad purchase, that money could be instead invested in stocks and enable you to buy more later. Do you think tech and the Magnificent Seven may continue to outperform? So the Magnificent Seven, that's the 5 companies I provided some numbers on earlier, along with the Nvidia and Tesla, and I think they can definitely continue to outperform. I like the old quote by, I think, Mark Andreessen, that software is eating the world, visualized by a whole bunch of old products and technologies that have all now been replaced by apps. So instead of having a radio, now we just have a podcast app and so forth. But that part of software is eating the world is superseded by the Magnificent Seven eating software. I think there are a lot of companies that are currently very profitable within the category of tech that will be eaten by the Big Seven. And I think the Magnificent Seven here across the board are very profitable, have very good growth prospects, and have some real underlying kickers of being able to really create transformative stuff. And I would be very scared to not be a shareholder on these based off of that potential. So thank you very much everybody for watching. Thank you very much for all the questions. If you have you didn't have a question in advance, but maybe you have a question later, you can always leave a comment on any of my posts on eToro or write to me on LinkedIn. And thank you very much, and I hope you all have a great quarter.